Today, we are talking all about GDP here in Canada. How is the overall economy doing? Well, we got some important data on Friday, which gives us an inclination of what the first 3 months look like for the start of 2023. And obviously, everybody is concerned about a potential recession. So we'll break it down. We'll look under the hood to see what these numbers look like. Then we'll take a look at what the economists are saying about what the rest of the year could potentially be. And stay tuned to the end because I will give how I am taking advantage of a potential / looming recession and what I'm doing personally in my portfolio. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. So first things first, let's take a look at what these GDP numbers are. And first and foremost, the GDP is super important because it does help us gauge the health of the national economy. Everybody watches this to see different sectors and different areas of the economy and how they are performing. We'll discuss a little bit on that later, but we do see highlighted the first 3 months, we do see growth of 0.6%. Now, it does not seem like a lot, but when we talk about 0.6% of what Canada's overall GDP number is, not bad whatsoever. When we go back to January, we actually did surprise. We came out with a 0.6% growth, which was way better than expected, what the analysts, what the economists had predicted. But we do see the economy start to fall off in February. We only saw 0.1% growth, where the actual expectation was 0.3. Now, the numbers are not finalized for March as of yet, but what the economists and the analysts are predicting is that it will contract. We will see the first month of the GDP contracting and it will be down 0.1%. So still not bad overall, but let's break it down a little bit further to get a better inclination of what's going on, maybe even sector by sector. Looking now at a report from RBC, we can see that the construction spending remained firm in February. Oil and gas extraction rose, but manufacturing, wholesale, and retail sales all declined after rising in January. And this is definitely a concern because what we're seeing now is the higher interest rates actually impacting the consumer. People aren't buying as many goods. People aren't going to spend. This will definitely help in the slowdown of Canada's economy overall. When you look at GDP on an annualized basis, it is still up 2.5%. But the biggest question is, now that we've started to see signs that the economy is slowing, just how long will these numbers stay positive? Now, to remember, a recession is 2 consecutive negative GDP quarters. We're definitely not in a recession territory today, but let's look a little bit further to see what could potentially be happening throughout the rest of the year. This report goes on to show with GDP growth tracking weak momentum into the second quarter, the Bank of Canada is not expected to hike interest rates again. And the hikes that they've done so far could show signs that they were kind of on the right path or doing the right thing. Now, when we take a look at what the GDP summary looks like, it gives us an indication of some of the sectors that they track. We did mention some before: manufacturing down in the quarter, construction up, oil and gas extract up. Then we have retail, food, and some of the other areas that are concerning because what I said before, and just to highlight again, is that these higher interest rates are taking away discretionary income from consumers, making it hard for them to spend, focusing more on paying mortgages, food, etc. With that being said, it gives us a depiction of we started off in January really strong, but now we're starting to see signs that what the Bank of Canada had kind of hoped for in terms of slowing the economy down is coming to fruition. So now let's take a look at what some economists think is going on with the economy here in Canada. We'll start with Charles St. Arnaud. He says that the reduction or the softening in the Canadian economy is something that will be welcomed by the Bank of Canada. It suggests that they were right on their decision to hold in April, and they believe that the Bank of Canada will leave its policy policy rate unchanged for the rest of the year. So although the economy could be softening, they are not going to cut interest rates anytime soon. Stephen Brown from Capital Economics believes that the strike action happening here for the federal workers will have a negative impact on GDP, and it sets the stage for a much weaker second quarter. Now, GDP could decrease by as much as 0.3% month over month this month as a result of the strike. Even if the strike was resolved and GDP fully rebounds, we would still be on track for that first quarter of negative GDP growth. Nathan from RBC Economics says that GDP growth is tracking weak momentum into the second quarter. Bank of Canada is not expected to hike again, although inflation is still too firm to justify a shift to cuts, even with the economy showing signs of weakness. So again, another one saying there is no cuts even though the economy is slowing down. So we'll read on to see what Douglas Porter had to say, and he shares the same sentiment. The Bank of Canada is expected to remain on hold, assuming inflation continues to recede, and notwithstanding their tough talk on the possibility of future rate hikes. Now, something that is concerning is what is happening with the core inflation. And what we can see here is what is happening with core inflation here in Canada, and we're actually seeing an uptick within the past 3 months. Now, what is core inflation? Core inflation is the change in the cost of goods and services, but it does not include those from the food and energy sectors. Now, when we look back at these numbers, getting an indication, we've taken food and energy out of the numbers, and we're seeing inflation still climb. Now, gas prices have, shot up a little bit. Food prices have also been high. Although the overall trend of inflation is down, there's still numbers or still areas within inflation that are being persistent. So what Douglas is saying is that, we have the possibility that if these numbers stay sticky, if these numbers stay relevant, then there could be potential, even future rate hikes, although the economy is showing signs of weakness today. Mark from TD Economics says that their view is that the Bank of Canada will hold the policy rate, the interest rate, all the way to 2024. And as lagged effects of the interest rate hikes still need time to work their way through the economy. Goes on to mention about the strikes, but what the overall consensus is that interest rates are not going lower this year. They will continue to see what the economy does, but based on the numbers that we've seen so far, there's most likely going to be some weakness and potentially even a recession for 2023. So I guess that begs the question of what I'm doing to take advantage. We know that the market has been resilient, taking this information in and only seeing short blips of sell-off before people start to get back in. Could you make the argument that stocks, certain companies are still expensive? Yes. But when we talk about the overall long-term picture, especially if you're investing in 5, 10, 15, 20 years, it's always good to buy when you have that money available using a dollar cost average strategy that we've talked about many times before. But for me personally, I just can't seem to find a company that I want to add into my portfolio. So the way I am taking advantage of this is using a high interest savings account ETF, using it in my TFSA that's yielding me 4%. So I'm getting 4% on that money. I'm not subject to downside risk. It's not going to go down in value. And what I'm doing is I'm researching so that if an opportunity presents itself in terms of a company selling off because we do head into a bad earnings season, further down the line, whether that's in the summertime or heading into the fall, if these companies start performing poorly and we happen to have a sell-off in the stock market, I will basically have this cash waiting on the sidelines to get into the market. So what I'm saying here is that I'm almost welcoming of a recession. I know that the economy does rebound time and time again, and especially with the thought process that I'll be investing for 20, 30 years from now, but keeping that money on the side invested in a high interest savings account means that I'm liquid. I could easily sell out of that and move into a position, but I'm also not missing out on any potential returns because it is yielding me a 4% return. Now, realistically, when you look at it, I've always said don't try and time the market. But in all of the factors that I've seen so far, I just think that there will be future opportunities down the road. And that is my own personal opinion. I do not have a crystal ball by any means. We've raised interest rates at an expedited pace over the past year. We have housing prices that are ridiculously high. We have stock prices that are really high in comparison of what the true value is of the company. I think that there will be a time where money continues to constrict, get tighter in the consumer's pocket. It will continue to impact what's happening on a GDP level, what's happening in people's personal finance, and most importantly, what's happening with company earnings as we continue to trickle down. With the Bank of Canada not making any cuts, this problem should continue. And unfortunately, we will probably lead to tighter times or possibly even a recession throughout the end of the year. And then I'll be ready with my cash savings to deploy into the market, into a company that I've done research on and believe I can hold for the next 20 years. So let me know down below, are you thinking along the same lines or are you bullish from here on out? Let me know down in the comments. If you like this video, make sure to check out the video that I did on the high interest savings accounts ETFs. And if you like dividends, make sure to check out my dividend ETF video here. I hope you all have a great week in the markets. Happy trading.